Good afternoon, everybody. Welcome to our Selecting an Option Strategy webcast. I'm Connie Hill. We're here each and every Tuesday afternoon where we talk about different types of option strategies and what the market might be conducive to. Now, how many of you think, and you can answer this in the chat if you're here live, how many of you think that maybe we'll have some increased volatility, say over the next month or so, as the new administration is rolling out their policies and tariffs or no tariffs? How many of you think maybe that might inch up a little bit on us? Well, I think it may. And today we're going to talk about a strategy that could potentially be used in that kind of environment. Now, I hope you're following me on X. I'm Connie Hill CS. We have the pleasure of having Cameron May in the chat here to help us out today with some questions I might not be able to get to. He'll cover those. He is on X as well. He is at Cameron May CS, and we'll post educational content, different things that we might notice in the market that we think you might find interesting. We'll go ahead and share those ideas with you in our X posts. Let's go through our disclosures and we'll talk about our agenda. Those of you that are responding, those of you that are responding to, you think there might be some additional volatility. I agree. Most of you are saying, yeah, probably so. All right. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for general information and educational purposes. You shouldn't consider it a recommendation of any sort. We will be using the Paper Money software application. This is what you download to your computer. It is the most robust version of Thinkorswim. It's nice that you can practice in a paper environment, so consider doing that. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. When we set up a stop loss order, there is no guarantee of the actual execution price. We try to get stopped out in a certain area, but there's no guarantee of that price. Now, I want to bring your attention to this. Hopefully, you're seeing us announce this quite a bit so that you're aware that we have some upcoming in-person workshops. How much do they cost? They are free. We are so nice to you, I can't believe it. They're free. We even feed you some a light breakfast, or maybe it's even a bigger breakfast these days, I don't know, and lunch. And so if you can get to Scottsdale, Chicago, or Detroit, you will be happy that I kind of gave you a nudge in that direction. Something we don't have as often is an advanced options workshop. That's what we'll have in Chicago, March 21st and 22nd. So those of you that maybe have been, I'm going to say, more veterans in the market, you might be able to go to that and appreciate it. If you're new and you still think you might benefit from it, by all means, go ahead, sign up. They fill up really quickly. Okay, so if you have any interest at all, go sign up. You can always cancel it later. All right. What we like to do in this webcast is take a look at the current market conditions, kind of talk through what has been happening, and then we'll talk about what option strategies might be best in the environment that we're seeing. And then, of course, we're going to do several examples on the platform. Now, I kind of teased you a little bit saying, maybe volatility might be a prominent theme over the next month or so as the new administration rolls out their new policies. And markets don't like uncertainty. And so, that could cause a little bit of disruption. Let's go take a look at the markets here. Actually, before I show you that, I want to show you where you can sign up for one of those workshops, okay, that are in your area. Come to the Learn menu. All right, right here, and then Schwab Coaching. That's the menu that I'm on right now. Come to Schwab Coaching, scroll down a little bit. Come over to this third area. It says in-person events. You can pull the calendar and you can see everything that we have coming up. All right. Some of them, we've even got some that we have scheduled out quite a ways into the end of the new year. We're clear out here even to November and December, which is amazing. All right. Some of them you can't register for yet, but go take a look at those if you're interested in attending. I think you'll enjoy your time there if you go. It'll be well worth it. All right, now I'll take us over to Thinkorswim. And as we jump over here, I've got the SPX up. And let's just kind of, maybe I'll do a little bit shorter term of a chart. Let's look at 3 months so we can kind of see what has been happening more recently. So, what was it, Monday? Monday was a big drop in the market. It gapped down over the weekend. It had been trading lower due to what? Due to new tariffs being introduced, and that they were going to be coming effective on Canada, Mexico, and China. And so the market, doesn't like that kind of uncertainty. What's that going to do to the economy? So we had a big gap down. Well, that was only 1 week after we had another situation again on a Monday where the market was up here at an all-time high, and then the very next day, big gap down. That had to do with something else. It wasn't necessarily administration policy. It had to do with, what was that app that some people thought maybe could replace TikTok, but that DeepSeek. And so that put some uncertainty in our market. Now, as we look at the other indices, the NASDAQ, the Dow, the Russell 2000, all of them had a similar reaction to what we're seeing here on the SPX. Now, on the volatility index, the VIX, the day that the initial volatility was a week ago Monday, we had been down here about, say, let's see, the close was 1485, and it gapped up here to about 18 and change. Okay, so that's kind of a significant gap when we're talking about volatility. Ran up really high, and then as the day kind of calmed down, volatility dropped a little bit. Now it's not down into super low areas. Let's look at a full year for this. Super low, where we had been for the last year, the low areas were around 12 and 13. And so when we get down maybe below 15 or so, then the market seemed a little bit more relaxed, not as concerned. But if it starts creeping up into the high teens and into the 20s, then we are feeling more of the volatility in the market. We'll start to feel that more so. So based on what has happened, and based on the fact that new policies are probably going to be rolling out daily, news of different things going on with what they want to do and what's happening with the tariffs, yeah, we could experience that. Now, I'm going to have those of you that are here, I want you to answer this question in the chat. Given what we're looking at here, what kind of strategies do you think might benefit most from an environment that has a little bit higher implied volatility, not skyscraper volatility, not super high like we saw this day last December, or even further back when it was up there at 65. What kind of strategies do you think we might benefit from? We're going to go back to our slides here and look at all of them. This pretty much is our arsenal. All right. Could there be other trades that we do? Sure. We could add a leg here and a leg there to do some hedging or something like that. But overall, these are probably the strategies that you're thinking, okay, what could I use to do so? Now, when we have implied volatility high, what does that do to the option prices? Well, it inflates them, right? And so knowing that, then we probably want to do something that incorporates selling some premium on a leg or something of that nature, which could lead us to maybe any one of these type of strategies, with the exception of a long call. Options will be pretty expensive, so you've got to have a big move out of a stock to have your long call work. And that's true downward pressure as far as a long put goes. It'll be more expensive. And so selling some of these strategies might be more ideal. So many of you are saying credit spreads, selling premium. Yeah, incorporating some sort of selling action. Now, if implied volatility, if we think maybe it's going to be going up, then does that help us eliminate maybe some of these strategies? Well, what we're going to talk about today, we're going to talk about, where did it go here? We're going to look at a call diagonal spread and a put diagonal spread. What does the spread entail? Well, we're going to have a short leg that we sell in a shorter time frame. And then we're going to have a longer leg dated further out. And if implied volatility creeps up, like we think maybe it might, well, that will help this longer leg, right? Because maybe we sell some premium, but if this goes up on that long option, well, that increases the price on it, which works to our advantage. Okay, so that's where we're coming from here today. Now, I have a couple of trades that we're going to simulate and look at. And one of these I put in before the market closed, okay, because they were announcing earnings and I wanted to get it in before the market closed, okay, so I did. So let me show you what I've got going on here and what we're looking at. We're going to head back to Thinkorswim. I'm going to bring you over to my monitor tab. And I put a trade on here on Uber. Okay, so let me show you what we've done. I don't know if they've actually announced yet. Let's see what time they're supposed to here. Okay, yeah, they actually do it tomorrow. Okay, I knew I needed to get it on before the market closed, but actually we'll be able to look at this tomorrow, okay? Because that's when they're going to announce their earnings and have their conference call. So we're in it a day early, which is good. All right. If we want to take advantage of something over earnings, and this is the only trade we're going to do for earnings, we do need to have it in before the market closed because tomorrow morning, before the market opens, that's when they're going to announce their news. So what do we have going on here? We did 3 contracts here. And let me, maybe I'm going to get rid of this for a little bit because I want you to be able to see the strike prices here. So we sold in the closest month, the closest weekly that expires on Friday, the 7th of February. We sold a 75 call and we brought in some premium. And then we went out a week further in time. So we did the February 14 expiration date and we bought something that was a little bit out of the money. All right. And so the strike prices, there's about a $5 difference here. And the idea in our most ideal world, what we'd want to have happen is by the time this option expires Friday, we would love to see it about this 75 area. Okay, so wherever your short leg is, that is most ideal. Now we're going to be using the risk profile today. I hope you guys are getting more comfortable using the risk profile. For certain types of trades, I think it is really helpful to use, and diagonals is one of those trades. So I'm going to come over here to the Analyze tab, and because I already have the order in, nope, we don't want the VIX here. Let's go back to our Uber. You can see our little trade down here. Let me change this. I think we actually executed at 75 rather than 76. I was toying around with it. So yeah, we got executed at 75 strike. So as we come to our risk profile, we pop in Uber, kind of shows us, kind of maps it out for us. Now, there might be some of you that are not super familiar with the risk profile. I know in our Getting Started or our Exploring Thinkorswim classes, we teach you, we spend like a whole session on the risk profile. And I'm going to tell you, it usually takes several iterations of seeing it and using it and seeing how people use it to really feel like you get it really well. Okay, so if we talk about things today and this is your first or second time seeing it and you're kind of like, not so sure I'm following along, that's okay. Okay, the repetition will help you quite a bit. But if you're not oriented with the risk profile, let me just show you a little bit of what we're looking at here. Over on the left-hand side is our money, basically our profits and our losses. And you can see at the top of the scale is a plus $400, and down here towards the bottom of the scale is a minus $300. Okay, so we can kind of see what our profit loss might be based on either options expiration, which is the teal colored line. You might see it as green on your screen. Or as of this date here, which really represents today or another day that we might select, okay? And so that kind of that purplish line would say our expert would be the trade through whatever the date is down here, which right now I just have set it today. We can go into the future and we can change that if we want to. Now down here on the bottom is basically the price of the stock. Uber closed today in the neighborhood of about $69, $70. Okay. And so we can see kind of this little notch right here tells us what the current price is. And then we have, oh, actually, that's the wrong line. Oops. Okay, really this one is what the current price more so is. This smaller one that I did first, that's more representative of the break-even point on this trade. Now, as we follow this, what we're going to notice is that our peak profitability up here aligns with what? It aligns with our short leg. So this is a strategy where we're hoping to bring in some premium, and we sold some. And then our longer leg, our expectation is we're wanting it to go a little bit directional, but we're not expecting a huge move, okay? We're expecting a smaller move. Because you can see the range here, say at options expiration, this is we're gonna say 69 something, okay? All the way up to the peak of 75. And then you can see as the price of the stock goes higher and higher, what happens? Well, we actually stay in a decent profitability range. And so if implied volatility does ramp up on us, great. We've got this long leg that will benefit from implied volatility or volatility in the market overall coming into play. All right. So how many of you have worked with the risk profile before? Go ahead and chat that into me. I'm not seeing a lot of chats at the moment, so I hope my feed is still happening. Okay. Let me know if you've used this before. Now, we're going to, a date up here is really important. We want to make sure we have it formatted correctly. And the date we want to put here, because we have two expiration dates, we want to put in the latest date. So we're going to change this over to the 15th of February, okay, because the one that expires last is there on the 14th. So we're going to put in the 15th here. That adjusted our screen a little bit. And then I'm going to come down to this box. I hope you can follow my giant purple hand over there on the far right-hand side. And as I click on this menu icon, we're going to set the slices to the break even. And the furthest out date it's going to let us go looks like here's the 8th. Okay. So a price slice is nothing more than this diagonal line here. But what it does for us, it tells us percentage-wise expectation for the price of the stock expiring anywhere from, it says a 44.50 if you can't read that. From this break-even line over, there's a 44.5% chance of the price of the stock being at that break-even point or lower. And there's a 55.5% chance that it's going to be between the break-even price or higher. Okay, so probabilities, it's not quite 50-50. There's a little bit more to the bullish side here, right? Prices getting higher. Now, let's see, those of you that have used the risk profile before. So we've got some yeses out there. Kevin's used it, but maybe not a lot. Ted used it on a different platform, so you're familiar with it. Perfect. Will's listening. Okay. Bob says, maybe many years ago. All right. Now, I don't know that we necessarily have to do this on every trade we put on. In fact, many times I don't. But there are certain trades I think it helps us visualize what we're expecting and what we want to see happen by using the risk profile. Okay, there might be some strategies where it's not that, I'm going to say useful or helpful, like if we have a long call or a long put, right? We just know, directionally where we want the stock to go. Bridget says that Brent Morse did a class on the Analyze tab, which was really good. Now, our teaching schedule changed a little bit, and our class content changed a little bit in January. But if you do go into the archives, and maybe we could have Cameron find this link for you. Brent was teaching the Exploring Thinkorswim class. Yeah, and he spends a lot of time in one session showing you the ins and outs of this. I'm just showing you some rough details, so hopefully you can follow along. Okay, but thank you for letting us know that, Bridget. All right, so tomorrow we'll see earnings come out. Let's talk about these strike prices that we selected here. We means you are along the right with me, okay? Let's go over to the charts for just a moment. Oh, before I do that, on the trade tab, I wanted to point out to you the market maker move. All right, this little group thing here, it kind of looks like barbells to me, but it's supposed to be 3 M's, 2 M's on one row and 1 M on the bottom for the market maker move. And this basically tells how much implied volatility is priced into the options for this event. Well, the event that it's doing right now is earnings in the morning. So it's expecting a move of about $5.44 by the end of tomorrow. Okay, that's the move that it's expected. Here on these February options that expire Friday, it goes a little bit further out. This says a plus or minus 5.87. Okay, so by Friday, then yeah, it's expecting a little bit more of a move, but the big chunk of it is for tomorrow. Okay, so I wanted to show you this. Now, hopefully you guys have seen this before, where we have the market maker move on the chart. Okay, so it maps it out for us with this yellow dotted line here, yellow dotted line there that's kind of really close to support area. Let me get rid of a couple of lines so you can see it better. Okay, that's the range that is expected, that's priced in to the options. Now, does the stock always move exactly where the market maker moves priced in? You know, it doesn't. Okay, it would be really nice if it would cooperate and do that more often. Okay, sometimes it might not move as much, and sometimes it might move way past it. Okay, now Uber is just recently kind of turned the corner where it's finally started to put in some higher highs and higher lows. And so kind of more short term, this red line's my 30-day, is starting to do what? Starting to uptrend a little bit. And so it was for that reason that we decided to do a call diagonal instead of a put diagonal. And we know our peak profitability price is at about 75. Well, this market maker move here is at 75.19. Now, there might be some of you that don't have this market maker move. Let me share that with you. I don't have we'll go from here. I was going to say, I don't have it listed over in my notes, and I usually do. So I'm going to share this with you, okay? It's going to create that URL. And for those of you that are here in class, I'm going to post it out in the chat. Remember, anytime we share a script with you, it's never guaranteed at price or it's not guaranteed as to accuracy or timing. Those of you listening to this on the recording, I'm going to post this in my chat area. I'm just going to highlight it, make it bold. Hopefully you'll be able to see it a little bit better. We make it white and bold. All right, hopefully you can see that better. And then those of you, maybe there might be some of you that are not used to knowing what to do with a script. Essentially what you do, you just come up here to your own Thinkorswim, go to setup, say open shared item, and then you can copy and paste or type in this URL. And if you want, if you're typing it in, you don't even need all of it, okay? I will delete up until, I think I'm actually accidentally deleted it. Oh, no, I didn't. Where the exclamation point is. Exclamation point and those characters to the right of it, there should be 9 total. They're cap sensitive. You want to put it in your open shared items, hit preview. I'm not going to hit import because I don't need it in there again. Okay, you only have to do this once, but you have to remember what you saved it as. Okay, So you might put in there, I call mine market maker move, all right, to show up on the chart. All right, so you'll notice our strike price that we're long is pretty close to what the price of the stock is running right now. And with our bullish bias, we're saying, okay, if the market thinks that maybe it could be getting up to 75 or that area, that's why we sold the 75 strike, okay? Because I know there could be a lot of questions, why which strike? And you don't have to do it this way either. You may have other ideas. We're just doing a very short diagonal here with the expectation of kind of a short-term move. And so tomorrow, when the market is open, the news is out, and we see what's going on with this trade, you can come over here to your Analyze tab and everything will have changed, okay? We expect implied volatility to come crushing out, right? After the news is out, we expect that to drop. And we can see it's kind of been creeping up here a little bit. But once that news is out, it probably will drop again. But then after that, we'll hope that it creeps up a little bit more so that our 70 call will just continue to increase in value, okay? Because that's going to be our long leg is going to be that 70, and it's got an extra week's worth of time out to February 14th. Let's see, Alexa says, is the market maker move line in the chart an out-of-the-box experiment? Not really sure what you mean by an out-of-the-box experiment, but basically one thing we know is that if we take the at-the-money call and the at-the-money put, typically if we add those two together, it will sum up to essentially what our market maker move is. Okay, that we're looking for that much of a move. And it takes into consideration that most of the implied volatility typically is going to be on strike prices that are pretty close to at the money, because they may have some intrinsic value, they may not have some intrinsic value, okay? Just kind of depending on where that price lies out. Okay, so on this one, say well, on a diagonal, we're doing two different strike prices. But that's where the information is coming from as far as the market maker move is using the at-the-money call, the at-the-money put, and we're looking at the most recent time frame here. Hopefully that helps. I'm not really sure, again, what out of the box is, but it's not an experiment. It's actually just a nice visual that helps you see what is expected. But it doesn't mean it's going to happen. There's never a guarantee that it's going to go there. And so it's kind of interesting. And sometimes I'll go in and I'll make this line, I'll go in and draw it in a way like with the price level here, because then the next day I'm kind of curious to know how far it moved away from it. Okay. Because that line tomorrow will change. So I've got it in roughly the spot where it is right now. Okay. Any questions on that particular one? Okay. I'll be watching it tomorrow to see what happens. Now I've got a couple of other ones to show you here that don't involve earnings. Okay. This particular one did. But you know, some of you are traders that you're like, man, just get our earnings over with. All right. Then I'll trade it. So next one up here, we're going to look at, let's do this one. Let's do TM. This stock, Texas Instruments, is a tech stock, and we can see it already had its earnings. Okay. We can see what the trend has been. Like right before earnings, maybe there was some expectation that it was going to do well, and then it disappointed based on what it said, and it got gapped down here, and it's just continued to drop a little bit. Now, it's not dropping huge. Okay, it's not like enormous, but it is still continuing to move. And so the same thing here. If a stock is falling in price, what should be happening with implied volatility? Well, it should be ramping up, at least to some degree. Now, sometimes it'll be steep, sometimes it won't be quite as steep. And so in this case, would it make more sense to do a call diagonal or a put diagonal? Okay, just looking at what we're seeing here on the chart right now, would it make more sense to do a call diagonal or a put diagonal? Okay, well, for purposes for an example trade, we're going to do a put diagonal with the idea that we still think there's the weakness, and maybe it's not going to drop dramatically, but the expectation is that it still will continue to drop. Now, I do have the market maker move on here, but there really isn't an event that I'm aware of that's being priced in here because their earnings is already over. And so then you'll typically see that there's not a lot going on there, meaning there's not a big difference. All right, so let's come back here. Let's go to our trade tab on TXN, and you can see where the implied volatility is. I'm going to say it's a little on the high side, but not extreme. But this very front weekly one has a lot of implied volatility priced into it. So it would make sense, hey, let's sell some of that, okay? So our short leg, we're going to start out. We're going to be doing we're going to sell this week. The one expires on Friday. And then we are going to start out here. Let me see what I decided in the end. We're going to go with the 170 that we're going to be selling the 170 here in our short month. And so to put it on, typically I'll start with my leg that's going short. Okay, so we're going to sell this. Let me see if I'm having a second thought here on that. Oh, no. Okay, it's actually the 175. I want to sell the 175. Many times you'll look to sell a 20-something delta or a 30-something delta. Something typically a little out of the money is where we want to sell. And then we're going to say buy diagonal. And it knows that generally it's going to be a net debit, but sometimes it works out that it's not, okay? And then we're going to go out here. We're going to go out to the 14th again. So we're just going to go the next week out. And then what we're going to grab, we'll open it up here. We're just going to change it here. And the strike price we're going to go for is we're going to do the 175. Okay. So we want to see some movement. It's a little bit out of the money, but it's not way, way, way out of the money. Okay. Let's change this strike price here to 170. And it's interesting, sometimes we might end up with a teeny little credit. Sometimes we end up with a small debit. Just kind of depends on how much implied volatility has been priced in and kind of where your strike prices kind of fall out. Now, what I want to do is take a look at this on the risk profile as well, knowing, okay, if we're short the 175, more likely than not, that's the direction we'd like it to go a little bit, which is about a $5 drop. Okay, so let's do analyze trade, if you're doing this with me. And we'll bring it over here. Now, we need to make sure our dates are okay up here. So up here, we want to change this to the 15th. Okay, so that's the day after our latest dated option. And then we want to come here and say set slices to break even on the latest date that it'll give us, which is going to be the 8th there. Okay. The price slice, again, designates just kind of this vertical spot here wherever it crosses the zero line. Because that tells us, okay, where is our break even? Now on this, we're going to spend a little bit more time. We can see our peak should be here at 175. That's our peak profitability at options expiration. Well, as time continues, we've got 3 more trading days after today. Our expectation is that the theta value will decline, right? It'll continue to erode our option that we sold, which we love. And ideally, we would want to see the kind of the price of the stock be at a point here where it's crossing in, somewhere in this area, okay? If we can close it out at 175 on the spot, man, that would be awesome. Don't expect it to happen, okay? But that's ideally what we'll be focusing on. And then we're gonna have our, we had an extra one in here. Let me get rid of that, sorry. Okay, there we go, that looks better. We're just gonna do one contract here, okay? And again, yeah, our peak profitability is at the 175 at options expiration. But if we come over here and we work with, say, the date, okay, if I advance this date here, I want you to see what kind of is happening here. By the time we get to Friday, the percentages have changed a little bit. Now this is up to, it looks like 80% almost here, that the price of the stock will expire between this point here, the break even, and going on up, okay? Which in this case, now this one's a little bit different. Ideally, what we might want to see is, when I said don't plan on it necessarily being right there at 175, but maybe you find a range. You say between this range is where you would like the stock to go for peak profitability. Okay, so let's go ahead, let's put it in. We're going to do a confirm and send, and I'm going to put it to our options strategies folder where we keep track of our trades for our class, our example trades. Now, I do want to do a little follow-up with you on some of our trades and see what's happened with some of them from last week. It is helpful, I think, to not just find entries and not just talk about getting into a trade, but doing what we need to do to manage the trade, okay? We had a couple of trades that we are out of. We were in them last week, but we're not this week. The first trade here, I'm gonna just bring up the chart, KTOS, and let's maybe change this back to our 3 months so we can just kind of look at it more granularly. We saw this stock having a flag pattern. The day that we talked about it, it broke out of the flag pattern. And our expectation was that this stock was going to move about the height of whatever the flagpole had been. We were expecting to move up to there. Well, guess what? It didn't do it. It disappointed us, okay? And so what we did is we put on a stop loss and said, you know, if it goes lower than the low of this day, we need to get out of the trade. And so it did. Took us out of the trade. We hit our stop loss. So we look at it here, and you know, sometimes you wonder in retrospect, well, should have I got out of the trade? And the answer is we want to get out wherever we've decided it's not profitable or not good for us to be in the trade, that maybe the stock can't survive. And even here, if we look out here, what would have happened over all these days? Time decay, time decay, time decay, going the opposite direction. Now, it may do something now, but for the time that we had, we really needed to get out. Okay, so we took a little bit of a loss on that. The next trade that we just barely got out yesterday. All right, and this is kind of an interesting one. Nanonuclear energy here. Again, we got in on this day, which is the 29th. We had our class here on this day, I believe. I think if I look at the calendar, the 29th was Wednesday. And what we were looking at here was just a long vertical, okay? And actually I take that back, a short put vertical. I wrote in our strike prices down here. It was a 28.27 short put vertical. And here is the strike that we were short, the 28 strike price. Look how much leeway we had here. So as time is decaying on us, great, what happened? Went ahead and executed our order that we had sitting in there because we had said, hey, if we can get a chunk of this, let's take it and get out. So we received initially a 38-cent credit. We bought it back for 8 cents. What does that equate to? What equates to what? 30 cents. Multiply that by 100 per contract. Okay, so we're looking at $30 a contract. we had 15 contracts here. So this ended up, not including the commissions, about $450 for those 15 contracts. How long were we in the trade? Not very long. Look how not long we were in. 4 days. Okay. And we had orders sitting there, so it took it and executed, and we're done with our trade. Okay, so those are two that we are finished with. Now, the other two, we're going to let them work. Okay, we have a path here, which is a short put. Hasn't done a whole lot. We've experienced some time decay. This is a stock we don't mind having put to us at the strike price of $14.50 if it works out that way. If it really drops and expires below there, come options expiration day. If we look at the chart here for just a moment, I want you to just kind of see what it's been looking like. So we saw it breaking through this resistance area, and that's what we were seeing. The order went in the next morning when the market opened, which was it was down, the price was down a little bit because it gapped down and then it dropped. And it went below our strike price here a little bit, but now it's just kind of been moving back. So it's at $14.43 right now. Our strike is $14.50, and our expectation is we're just going to let it work, because if it's put to us, great. We don't mind, okay? Ideally, if you're trying to seek for being able to keep all of that premium that we sold, then we're going to look for time to decay, and we're going to look for it to just kind of hang in there and hopefully stay above its strike price. Okay, so just kind of depends on what your perspective is there. And then we've got shop on right here. We've got a vertical here. Let me collapse this again. We've got a 116, 118 long call vertical. Shop had their earnings. They actually popped earlier today, put us in quite a profitable position with it. So we're up 220 on it, and we would like the stock to go beyond 118. So as we look at shop on the chart, let's see where 118 is. You can see I have it drawn in here. And so it's closed above it today, but we would like to see it continue so that we can get a good chunk of that, a good chunk of the trade, right? I think we put in divide back at either 70 or 75% if we had been able to capture that amount of the profit to go ahead and get us out. Okay, so we're just going to let it work. And that is the update on our existing trades. Now, I hope you're not a procrastinator. Sometimes I procrastinate, okay? But I hope you're not a big procrastinator. I hope you've subscribed to our Trader Talks channel, okay? If you subscribe to our Trader Talks channel on YouTube, it makes it easier for you to find our content. To do so, just go click on the icon that's in the bottom right of your screen. It looks like YouTube, but kind of more of as a blue logo, but the YouTube logo. If you select on that, that will subscribe you, and then it makes it easy for you to come out here to our Trader Talks and just see, you can see what's happening next. Well, happening next is going to be tomorrow morning, bright and early, Trader Talks. That'll be right at the opening bell at 9:30, and then you can see the rest of the lineup for tomorrow. You can also see any of the playlists of your classes you're interested in. It makes it just easier to find our content. So don't be a procrastinator. Go ahead, get subscribed, so it makes it easier for you to find our content. Now, do we have any questions here as we wrap up? If you do, now's the time to raise that question. All right. I hope you're getting more comfortable as we explore different strategies. I hope you're getting more comfortable why we might choose a particular strategy over another. And even though we've got some example here today of some diagonals, it doesn't mean that that's the only strategy you could be looking at here. Okay, just happen to have some market conditions that was like, okay, we could actually incorporate this strategy and have a little exposure to it. All right. Well, Cameron, thank you for your help out in the chat. I certainly do appreciate that. And thank you to each of you who have joined us here today. We'll follow up on these trades and other ones next week. We'll see you then. Bye-bye.